Okay, just waiting for that to start recording, and I'll spotlight myself. Right, so I guess everybody who didn't show up right on time is going to miss the introductory spiel. But anyway, so the first type of dividend we're going to talk about today is the in specie dividend, aka the in-kind dividend. And the idea here is that a corporation will declare and pay a dividend through the transfer of property owned by the corporation other than money. So in the private corporation context, where you would routinely see something like this, for example, is if a private corporation owns excess land that isn't used in its business, and the shareholders of the corporation want to sell the shares of the corporation to a third party. And the third party probably isn't going to want to buy the excess land because in the Alberta private company context, the excess land is probably someone's vacation property that they just try to sneak into the corporation, right? So that's got to come out. And so the dividend in specie is the way that this often happens, is that the corporation will just simply distribute that excess real property or whatever kind of excess property to the shareholder in satisfaction of a dividend. This does also happen in the public company context, not so much in Canada, but in the US, you will see transactions like this where a public company will pay an in specie dividend by distributing the shares of its subsidiary to its shareholders. So a fairly famous example of this in the Canadian context, just because there was a lot of litigation created by this transaction, was in 2007 when Tyco Inc. Distributed out the shares of its subsidiaries, Tyco Electronics and Covidien, by way of an in specie dividend to the shareholders. And this led to a bunch of Canadian tax litigation about how that was supposed to be treated for Canadian tax purposes. I think everybody basically lost, and it was treated as a dividend. But that's, so, does happen in the public company context as well. Just, again, not frequently in the Canadian public company context. The second type of dividend that we're going to talk about, as I mentioned, is the stock dividend. And basically all a stock dividend is that a corporation will declare a dividend and then pay it by issuing new shares of the corporation to the shareholders entitled to receive the dividend. The fair market value, like I said, of the new shares equals the amount of dividend that otherwise would have been received had it been paid in cash. In the private corporation context, one of the things you will see stock dividends used for is a means of effecting an estate freeze. So the corporation will pay a stock dividend equal to the fair market value of its shares immediately before the stock dividend. So that reduces the fair market value of the common shares to some notional amount. And then the next generation of shareholders will subscribe for new common shares for nominal consideration following the estate freeze by way of stock dividend. In the public company context, you do see stock dividends as well. And usually when stock dividends happen in the public company context, it's not to do something zany like an estate freeze. It's really just because what you're trying to do is give the corporation the option to not have to pay out cash in satisfaction of the dividend. So if you have investments, you'll get the circulars every once in a while where the corporation is going to pay a dividend, and if you don't respond to the circular, you're going to receive shares as a stock dividend. If you do respond and you like to receive cash, you can receive cash. So that does happen in the public company context as well. So if we flip to slide 3 of Deck 8, we can start talking now that we have that bit of background about what the tax consequences of receiving these different types of dividends are. And from the perspective of an individual, we're going to focus generally on non-cash dividends and stock dividends received by an individual. And generally speaking, from the perspective of an individual, this is pretty straightforward, right? So first, regardless of the medium through which the dividend is paid, whether it's money or property or stock, paragraphs 12.1J and paragraph 82.1A require that the amount of the dividend be included in income, right? So then we flip our way over to the definition of amount in subsection 248.1. By now you probably should not be surprised that we actually have to define the word amount for income tax purposes. But the word amount is generally defined as meaning the fair market value of property received, or the fair market value of things expressed in money. So in the case of a in specie dividend, the amount of the dividend is the fair market value of the property that the shareholder received in satisfaction of the dividend. For stock dividends, we have a special rule, which is in paragraph C of the definition of amount in subsection 248.1. And this special rule basically provides that in all circumstances that we care about in this course, but not all circumstances, the amount of a stock dividend is the amount added to the paid up capital of the shares of the corporation as a result of the payment of the stock dividend. So we haven't talked about PUC. That's actually in, as you've seen, that's in Deck 9. So we're going to talk about it later today. But for now, what you can assume is that the increase to the paid up capital of the corporation's shares as a result of the issuance of the stock dividend is the amount added to the stated capital of the stock dividend shares. So, as we're going to see later on in these slides, especially in Alberta and under the CBCA and in basically, I think, all the non-Saskatchewan provinces, you can add an amount to the stated capital of a stock dividend share that is less than the fair market value of the shares that are issued in payment of the stock dividend. So this definition in paragraph C of the definition of amount in subsection 248.1 is actually a very important rule because, like I said, the amount of a stock dividend for tax purposes could be wildly different than the redemption amount or the fair market value of the shares that are issued in payment of the stock dividend. So with that, we can flip to slide 4. And the flip side of having to include something in income as a result of receiving a non-cash dividend or a stock dividend is that the shareholder now owns something in addition to the shares that they held and in respect of which the non-cash dividend or the stock dividend was paid. And so that something else needs to have a cost for tax purposes, right? So that we know how to treat a subsequent disposition of that something else. So if the dividend is an in specie dividend, then subsection 52.2 deems the cost of the property received by the shareholder to be equal to its fair market value. This makes sense because this was the amount that the shareholder was required to include in their income, and it's the amount of cash that the shareholder was required to forego because they received property instead of money in payment of the dividend. And in fact, I would suggest to you that subsection 52.2 is really there for greater certainty that the same result would follow even if subsection 52.2 was not included in the Act and you had to just rely on common law principles to figure out what the cost of the property received as an in specie dividend was. For stock dividends, basically the rules are the same as you would expect given the existence of paragraph C of the definition of amount in subsection 248.1. That is, we have a separate provision, which is subsection 52.3, and that specifies the cost of the new shares is generally equal to the amount of the stock dividend based on paragraph C of the definition of amount in subsection 248.1. So in this course, where any stock dividend that we ever talk about is going to be received by an individual and not by a corporation, you can proceed on the basis that the amount added to the paid up capital of the shares of the corporation as a result of the payment of the stock dividend is going to be the cost of the stock dividend shares under subsection 52(3). There are, like, as we sort of just hinted at, there are some modifications to subsection 52(3) where the shares are received by a corporation on a stock dividend. So if you have a corporation to corporation stock dividend, those modifications can apply where subsection 55(2) has potential application to the stock dividend. That is so far beyond the scope of this course that we don't really need to worry about it. And that'll be a question for a later day when you're in practice. So with that, we can flip to slide 5. And slide 5, we're now talking about what happens to the dividend payer when the dividend payer pays either an in-specie dividend or a stock dividend. And mercifully, again, things are relatively straightforward here. So on the payment of an in-specie dividend, subsection 52(2) also applies to the dividend payer. And what it does is it deems the dividend payer to have disposed of the distributed property for proceeds of disposition equal to the fair market value of the distributed property. So as a result, if the property that the corporation is distributing is capital property, then the corporation should have proceeds of disposition equal to fair market value and a capital gain or a capital loss equal to the difference between the deemed proceeds of disposition and the ACV of the property. So, a pretty intuitive result there, I think. Then for a stock dividend, what we care about is paragraph M of the definition of disposition in subsection 248(1). And that provision applies to the issuer of the stock dividend shares, and it deems the issuer of the stock dividend shares to not have disposed of anything, or it clarifies that the corporation has not disposed of anything. So again, absent, like we talked about, very early in the course, income tax being a transactional tax, absent any disposition, there's no tax consequences for the dividend payer, at least under Part 1. What we can say, however, is that the amount of the stock dividend or the in-specie dividend is still a dividend for any other purpose in the Income Tax Act, right? Just that the amount may be different than what you would expect. And so as a result, if the corporation had, for example, paid a non-eligible dividend in specie or by way of a stock dividend, and it had a non-eligible refundable dividend tax on hand balance, then the corporation would be entitled to a dividend refund equal to 38 1/3% of the non-eligible dividend that was paid either in specie or by way of stock dividend. And similarly, if the dividend recipient were a corporation, which again in this course we're going to generally pretend is not the case, the dividend recipient could have Part 4 tax based on the amount of the in-specie dividend or based on the amount of the stock dividend received. We have a question from, let's see who's got their hand up. Whoever's got their hand up, Thomas, fire away, please.
So just to double check about the disposition component. Sorry. So imagine that a corporation have $100 worth of capital investment, and it has issued 5 shares equivalent to the $100 worth of capital investment, and then it is issuing another 5 share. Again, the amount of capital investment has not changed. Now there are 10 shares, so the 5 the extra shares being issued to the shareholders now worth like $10 each share. It would be considered as they have acquired a $10 worth in the capital investment. At the same time, the corporation has not disposed of the capital investment. Am I understanding it correctly?
So this is with the stock dividend. Yeah. So let me try to paraphrase what I think the fact pattern was, and then you tell me if I've got this right. So we're supposing a corporation has five. Let's say it's got a single class of shares, and it has issued 5 shares. And let's suppose those 5 shares had stated capital of $5 in total, so $1 per share. And let's suppose that further these shares have a fair market value of $10 per share, or $50 in total. And so then, suppose further that the corporation pays a stock dividend. And it does this by issuing 1 additional share on each issued and outstanding share. And so as a result, there are now 10 shares of the corporation. The corporation adds a further $1 per share to the stated capital of its shares. This brings the stated capital to $10 in total, but preserves it at $1 per share. And so as a result, the fair market value of all of the issued outstanding shares continues to be $50, but instead we now have a fair market value per share of $5 per share as a result of that fair market value averaging across 10 shares. And so the question would be, well, what are the tax consequences of that stock dividend? And so the tax consequences are, number one, for the corporation, nothing, because paragraph M of the definition of disposition in subsection 248(1) deems there to be no disposition by the corporation. Then for the shareholders, the amount of the dividend is $5, which was the $1 per share that got added to the stated capital of the shares. And so that's the tax consequence, is that the shareholders, presumably there's 5 of them, would all have to include $1 in their income as a dividend received from the corporation. And so the rationale, I think there's a kind of the question was leading into what's the rationale for this, just to confirm. And yeah, the rationale is that basically everybody's investment in the corporation remains the same, right? Everybody owns the same fractional interest in the corporation. Everyone continues, in this case, we're assuming there's 5 shareholders. Everybody continues to be a 1/5 shareholder in the corporation. Everybody continues to own $10 of fair market value of shares of the corporation. They just now own it through 2 shares instead of 1 share.
Okay, yeah, that clarifies. I think I kind of asked the wrong question, but you have clarified my doubt. Thank you.
Okay, well, whether by accident or by design, it's always good to have the answer. So there we are. Okay, that being addressed, I think we've said most of what we need to say about non-cash dividends there. So does anybody have any other questions before we just flip to some problems?
I had a quick question about the in specie dividends.
Okay.
Can the recipient claim capital cost allowance if they receive something like that?
Yep, absolutely. So, you know, with capital, so I mean, number one, what they have to receive has to be depreciable property, and depreciable property has to be capital property as well. So there's a couple questions of fact there right off the bat. So, for example, if they receive land, then no, you can't depreciate it because it's not depreciable property. If you receive, to use a case law example, a flight simulator, like a big room-sized flight simulators that like Air Canada uses for their pilots to keep them current when they can't fly. To use no, right? If you receive that and you're just going to flip it, so it's inventory, then no, you can't claim CCA because it's not capital property. But if it is a potentially depreciable property and it's capital property, then yes, it would be depreciable property, and then you can claim your depreciation deductions if it's available for use in the course of a business or to earn income from property. So again, another couple questions of fact. But yeah, as long as the property is good property and there's the good purpose, there's no reason you couldn't claim CCA. And this makes sense, right? Like the person who's received the in specie dividend has had to include an amount in income in connection with that in specie dividend. So it kind of makes sense that they would get to write off that cost if the property is depreciable property.
Great, thank you.
No problem. Anybody else? Okay, well, and seeing none, let's flip to slide 6. And this is starting with question 4 in the handout. So in our handout, ACO owns a parcel of land with an ACV of $500 and a fair market value of $1,000. ACO declares a dividend of $1,000 on shares held by A, an individual, and ACO pays a dividend by transferring the parcel of land to A. And so the question, which isn't super clear about what we were asking, but the question is really what happens as a result of the payment of that dividend by ACO. So working through this, when ACO pays the in specie dividend, it gets deemed by subsection 52.2 to have disposed of the land for its fair market value of $1,000. And so the result is that it realizes a $500 capital gain and a $250 taxable capital gain. So we know that ACO is going to get to add $250 to its CDA, being the non-taxable one half of the capital gain. And it's also going to add $76.67 to its non-eligible RDTOH, or its RDTOH Classic, if you want to use RDTOH Classic, all of which will be refunded as a consequence of the in specie dividend to our individual A. So the net result is that ACO should have tax payable of $100, give or take. ACO cannot elect for any amount to be a capital dividend since, as we talked about last week, subsection 83.2 requires that an election to be a capital dividend be made in respect of a whole dividend. And there's going to be inadequate CDA for that. We have a whole dividend of $1,000 and we only have $250 of CDA. There's a bit of a timing issue there too, where you have to wonder whether the CDA actually existed at the time the dividend was paid, since the disposition of the property occurs kind of simultaneously with the payment of the in specie dividend. I would argue it's probably fine, and you could do that if you wanted to, but you've got to have enough CDA for the whole dividend, which is just a complete problem here, and there's no getting around that. So from our individual standpoint, individual A has received a $1,000 taxable dividend. That's going to be included in income under paragraph 12(1)J and paragraph 82(1)A. And we're going to have to work through our gross up and credit mechanism, which for the sake of brevity, we're not going to do right now. But we know that the effective rate on this non-eligible taxable dividend is going to be 42.3%. So we can assume that our individual A is going to have $423 of tax payable on the $1,000 taxable dividend. And then subsection 52.2 will apply to the individual, and individual A will have cost in the land of $1,000. So that's problem 4, the base case problem. And then in problem 5, we have an iteration of this. And in our iteration, the question asks, well, what if instead of distributing the land as an in specie dividend, ACO sold the land to a third party for $1,000 cash and then distributed the cash to individual A as a dividend? And so at the corporate level, the results are the same, right? The individual A when the land is sold to the third party, our corporation ACO realizes the $500 capital gain because it has proceeds of disposition of $1,000 and an ACV of $500. So that hasn't changed. So there's still the $500 capital gain and the $250 taxable capital gain. We're still adding the $250 to the CDA of ACO. We still have $76.67 of non-eligible RDTOH or RDTOH Classic. And we still have the same amount of tax payable. And we still know that on the payment of a taxable dividend of at least $200 to our individual shareholder A, that corporation ACO is going to get a refund of its non-eligible RDTOH or its RDTOH Classic. So that's all well and good. Exactly the same result as in the first iteration. But now, where things might get different is on the actual payment of the dividend to ACO, because now we don't have this whole dividend issue anymore, right? We could now cause ACO to pay a $750 taxable dividend and a $250 capital dividend, right? We could just do it as two separate dividends, and then we have solved the whole dividend problem. And so suppose we did that, right? That we had two separate dividends, one for $750 and one for $250, which we designated as a capital dividend. In that case, then, number one, because we have our $750 taxable dividend is still in excess of $200. So that's going to cause ACO to receive a refund of its RDTOH or non-eligible RDTOH, which is great. And the $250 capital dividend is going to be exactly equal to CDA. And so it's going to reduce CDA to zero. So that's great. So again, different, but at the corporate level, largely the same, saving for the fact that CDA gets cleared out, right? But then at the individual level, things get quite different now. Because our individual A has now received a $750 taxable dividend. So instead of including $1,000 in income, individual A just has to include $750 in income. And so again, being a little bit lazy and just saying that we're going to have a 42.3% effective rate of tax on the dividend, the result is going to be that we have tax now of $317.25 instead of having tax of $423. So a reduction of basically $100 off of our dividend, and then the $250 capital dividend obviously gets received tax-free. So a pretty significant difference for A. And so if you are our individual A here, you have a pretty strong preference to you would have a pretty strong preference to have the corporation sell the land and distribute cash rather than to distribute the land. However, in real life, people often actually want to own the land for whatever reason that's being distributed in specie. So selling it to a third party doesn't really accomplish that goal. But there are ways around this in real life as well, that you could, for example, sell the land in exchange for a shareholder loan and then pay a dividend by way of set off against the shareholder loan and just do the two dividends and then pay the two separate dividends by way of set off against the shareholder loan. So there are ways around that, but the moral of the story is that with in-specie dividends, you do have to be careful because you do have that whole dividend issue with the CDA. And so as a result, you're generally not able to recover the CDA that you create on the deemed disposition of the property distributed in specie through the payment of the in-specie dividend. But you will recover the RDTOH. Everybody okay with those problems? Yep, we've Leah, go ahead.
So you can still recover the CDA or like pay out a capital dividend on a separate transaction, correct? Just not this, like during the payment of the in-kind dividend?
Yeah, absolutely you could. So in this case, if the corporation had, $1,250 of assets, it absolutely could just back to back pay a second dividend of $250. And so now the shareholder would have $1,250 of property instead of $1,000 of property, and you would have put the CDA to use. So yeah, in that sense, this only becomes a problem if the corporation's ability to pay dividends is constrained in some way. But if we're assuming, unlimited money and the shareholder has unlimited appetite for distributions, then it's no big deal.
Okay, thank you.
Okay, if that's it, then we can move on to problem 7 in our handout, and this looks pretty straightforward. So ACO declares a dividend of $1,000 on shares owned by A, an individual. ACO pays the dividends by issuing to A more shares of the same class. On the issuance of the shares, ACO adds $1,000 to the paid up capital of the relevant class. So, like I said, fairly straightforward. So we have on the payment of the stock dividend, the addition of $1,000 to the stated capital of the ACO shares. So as a result, when we dig into paragraph C of the definition of amount in subsection 248.1, we know the amount of our dividend is $1,000 for, again, any purpose that we care about in this course. So again, from ACO's perspective, this becomes a non-event. Because we have paragraph M of the definition of disposition in subsection 248.1 applies, and therefore there's no disposition of any property by corporation ACO, and so no gain or loss, no tax payable. If ACO had RDTOH or non-eligible RDTOH, the payment of this non-eligible dividend as a stock dividend would allow for recovery of the non-eligible RDTOH, but we don't know if there is any, so who cares? Similarly, if ACO had a CDA balance of at least $1,000, it could have designated this dividend as a capital dividend. But again, we don't know if ACO has a CDA balance, so assume it doesn't, and again, who cares? From individual A's perspective, individual A has received a dividend in the amount of $1,000, which was the amount that was determined under paragraph C of the definition of amount in subsection 248.1 because there was a $1,000 addition to stated capital. So as a result, that's the amount that our individual A has to include in income under paragraphs 12.1J and 82.1A. And then again, being lazy and just saying we have a 42.3% effective rate on non-eligible dividends, then we know that A is liable for tax of $423 on that dividend. Then we can turn to the shares that are now owned by A, and because the amount of the dividend was $1,000, we know that under subsection 52.3, A is going to have cost in the shares and an ACB in the shares of $1,000. So that's problem 7. Everybody okay with problem 7? Okay, seeing none, we can flip to problem 8. And so in problem 8, we have a twist on the fact pattern. So it's the same as problem 7. But instead of distributing its own shares to the subsidiary, or to the shareholder rather, ACO transfers shares of its subsidiary BCO in payment of the dividend. And so the BCO shares, as we see when we are on the next page of the handout, is that they have an ACB of $500, PUC of $500, or stated capital of $500, and fair market value of $1,000. And so the problem is asking, well, what happens in this situation? And this is a bit of a trick question because the phrase stock dividend is actually defined. And that phrase means the phrase stock dividend as exhaustively defined in subsection 248.1 means that it's a dividend paid by a corporation issuing its own shares. So as a result, what's actually happened here is that our corporation ACO has paid an in specie dividend by distributing shares of BCO, not unlike the Tyco Covidien in specie dividend of shares of a subsidiary that we talked about at the kind of slide 2 of this deck. So when ACO pays an in specie dividend, we're back to in specie dividends. It's basically exactly the same as with the land, right? There's no functional difference between the land and the shares here. So subsection 52.2 applies to ACO and deems ACO to have disposed of the shares of BCO for their fair market value, which is $1,000. And since the shares of BCO had ACV of $500, then the result is a capital gain of $500 and a $250 taxable capital gain for ACO. And again, ACO gets to add $250 to its CDA, and it has $76.67 of non-eligible RDTOH or RDTOH Classic, whichever one you want to use. And the result is that because we have a taxable dividend of, in this case, we're going to see it's $1,000. We have a $1,000 taxable dividend that's well more than enough to allow ACO to recover all of its refundable tax. So its RDTOH goes to 0, or non-eligible RDTOH goes to 0 because of a dividend refund under subsection 129.1. And again, because we have a single dividend of $1,000, which is more than our CDA balance of $250, ACO cannot designate this dividend as a capital dividend. It cannot designate any part of the dividend as a capital dividend, since that has to be a designation of a whole dividend. And then again, for our individual A, the result is the same as in the in specie dividend example with the land. Again, we have a $1,000 taxable dividend because that's the amount, that's the fair market value of the property that was received. So that gets included in income under paragraph 82.1a and paragraph 12.1j. Again, being kind of lazy, we're going to say there's a 42.3% effective rate. And we know that that's going to result in $423 of tax payable on a $1,000 dividend. And again, subsection 52.2 is going to apply to individual A and is going to deem individual A to have costs in the shares of BCO of $1,000, which was the amount of the dividend that had to be included in income. So that's problem 8. Everybody okay with problem 8? Okay, seeing none, we can go on to problem 9, which is slide 9 of our deck. And in problem 9, it's a really straightforward question, and it's back to our stock dividend problem. But now instead of doing something zany, our corporation, instead of doing a stock dividend, is just going to split its stock on a, it doesn't say what the basis is going to be, like assume a base, let's say it's a 10-to-1 basis that it splits its stock. And that's the question is, well, what happens on the stock split? And so this is something you haven't seen before in this course. And the answer is nothing happens. Nothing happens on a stock split. So stock splits are not discussed anywhere in the Income Tax Act. However, the CRA administratively has been very consistent in stating their view, and the courts have never disputed the CRA's view, that a stock split is a non-event for income tax purposes, provided that no amount gets added to the stated capital of the shares in connection with the stock split. So that's the important distinction between a stock split and a stock dividend. And as we talked about, stock dividends can have income tax consequences where stock splits do not. So if you've increased the number of shares, you've added an amount to stated capital, CRA is probably going to say that what you have done is in legal substance a stock dividend. Whereas if you just divide the number of shares into a greater number, so you just split on a 10-to-1 basis, no change to stated capital, then that's it. That's a stock split and it's a non-event. So in Alberta, we do stock splits under section 27.1 of the ABCA. Section 27.1 does not provide for any additions to stated capital on a stock split. So if you've done a valid stock split under section 27.1 of the ABCA, then you should have a good stock split for the CRA's admin position and nothing should happen for income tax purposes. Again, if you have added an amount to the stated capital of the shares in connection with what you are purporting was a stock split, you may well be outside of section 27.1 of the ABCA, and CRA would probably be within their rights to say that what you have done is in fact a stock dividend. And so the amount that was added to the stated capital of the shares in connection with the stock split is received by the shareholders as a dividend. So in our problem 9, if we assume that our corporation ACO has complied with section 27.1 of the ABCA, then nothing has happened, and the answer to the problem of what happens is nothing. Everybody okay with problem 9? All right, seeing nobody, let's flip to our next page, to slide 10 and problem 10. And so in problem 10, and this is, I teased this a little while earlier. So the question is, what if in problem 7, instead of adding $1,000 to the stated capital of the shares issued on the stock dividend, which had a fair market value of $1,000, what happens if ACO adds only $1 in total to the stated capital of those shares? And so again, we have $1 of stated capital. The question of whether the amount of the dividend, when you only add $1 to the stated capital of the shares, is $1,000, or whether the amount is $1. The problem kind of leans towards saying that the amount is $1. I actually think it's the opposite. I think that the amount of the dividend for corporate law purposes, the amount of the dividend for income tax purposes are different things. But I think I'm in the minority on that position. And that most people prefer to document these things by saying the amount of the dividend is equal to the stated capital addition. But even though the amount of the dividend is $1 for corporate law purposes, it's satisfied by issuing $1,000 of shares. Anyway, the other point to make there is that there is a typo in the slide. That should be subsection 44.2, not 43.2 of the ABCA. So just mentally correcting that. The question is referring to subsection 44.2 of the ABCA. And so the first part is, can you do this under corporate law? Is what we're asking. And the answer is yes. And so this is why we care about subsection 44.2 of the ABCA. Subsection 44.2 of the ABCA was enacted for the specific purpose of letting you do exactly what this problem is suggesting, where you can add to the state. So under subsection 44.2 of the ABCA, a corporation can pay a stock dividend, and it can add to the stated capital of the shares issued on the stock dividend any or all of the amount of the value of the shares issued in payment of the stock dividend. So there's absolutely nothing abnormal then in Alberta about adding only $1 to the stated capital of shares issued as a stock dividend, even though the fair market value of the shares is $1,000. And in fact, the numbers are usually even more lopsided than that. It's usually something like $1 million and $1 of stated capital. And that's, again, perfectly permissible. The Alberta legislature deliberately intended that people would do that. Similar provisions exist in basically every Canadian BCA, like I said, except Saskatchewan. So if you're going to practice law in Saskatchewan, be wary of that and make sure that you have either a workaround or, I mean, functionally everybody in Saskatchewan apparently just takes the position that notwithstanding the Saskatchewan BCA is different than every other BCA on this point, just pretends it isn't, which is an approach that you could take. But you will have to think about that. You'll have plenty of time to think about it because you'll live in Saskatchewan and it sucks. So that's part one of that problem. Then part two asks what the tax consequences are if we've done this thing. And so, again, this is probably now quite obvious what happens, but on the payment of the stock dividend, the amount of $1 was added to the stated capital of the corporation shares as a result of the payment of the stock dividend. So the amount of the stock dividend, by virtue of paragraph C of the definition of amount in subsection 248.1, is $1. So from AECO's perspective, this is a non-event because of paragraph M of the definition of disposition in subsection 248.1. AECO has paid a dividend of $1. So AECO could theoretically recover $38.33 of non-eligible RDTOH or RDTOH Classic, as the case may be. I'm actually not sure if a T2 wouldn't just round that down to zero. So functionally, you might recover zero, but in any case, it's a matter of cents that you would recover. And if AECO had a $1 CDA balance, it could designate the whole of the $1 dividend as a capital dividend, and so the shareholder A would pay no tax on the $1 dividend. You would not do that in real life. The cost of preparing your capital dividend election, et cetera, would be so vastly in excess of 42 cents that you would make absolutely, I mean, I just can't think of when you would ever actually do that with a high-low stock dividend. But I mean, you could if you were wanting to make a donation to the legal industry. Then from our individual A's perspective, again, because the amount of the stock dividend is limited to $1, then individual A has to include $1 in their income, and they're going to have, as I said, 42 cents of tax payable, which again, their T1 software might round down to $0 of tax payable. So it could be functionally close to a nothing for our individual shareholder. Individual shareholder A is going to have cost in the stock dividend shares of $1 under subsection 52.3. So, this allows, what you can see here is that subsection 44.2 of the ABCA and its analogs under all the non-Saskatchewan BCAs basically allows you to pay a stock dividend with zero effective income tax consequences associated with it. So a pretty neat result. Everybody okay with problem 10? All right, seeing nobody, let's flip to slide 11. And this is our last thing we're going to talk about before taking a break is slide 11. And this is subsection 15.1.1. And subsection 15.1.1 is the thing that you need to be mindful of before you get too carried away with stock dividends. What subsection 15.1.1 is it's an anti-avoidance rule that intends to prevent people from shifting value between one another using stock dividends. So to illustrate what we're worried about with subsection 15.1.1, suppose for a moment that we have a corporation called DCO. And let's suppose the shareholders of DCO are dad and daughter. And dad owns 99% of the shares of DCO, and daughter owns 1% of the shares of DCO. So what you could do in theory without subsection 15.1.1 is, in order to reduce dad's tax on death, you could have daughter exchange her 1% of the shares of DCO in exchange for shares of a different class than dad's shares. And you could then pay a stock dividend exclusively on that separate class of shares using a high-low stock dividend equal to the fair market value of dad's shares of DCO. So now, all of a sudden, we started with dad owning 99% of the shares, 99% of the value, and daughter having 1% of the shares, 1% of the value. All of a sudden now, daughter has a class of preferred shares issued on the high-low stock dividend that represent 99% or more of the value of the shares of the corporation. She still owns her 1% of the common shares, and dad's 99% of the common shares have basically zero value. And so as a result, dad's deemed disposition on death resulting capital gain is basically zero. And so by doing this, dad and daughter have effectively shifted all of the accrued gains on the shares of DCO to the next generation of taxpayer, and essentially circumvented the deemed disposition on death. This would also work in theory, again, absent subsection 15.1.1, but with a deemed disposition on departure from Canada, if we don't want to be totally morbid about why we're doing this, and various other things where there might be a deemed disposition. The moral of the story is that lets you shift value, and there may be some immediate benefit to shifting value to somebody who isn't you or to somebody who is younger than you, et cetera, et cetera. And so this is what subsection 15.1.1 prevents, right? And it actually prevents this in a pretty harsh manner, all things considered. So if one of the purposes of the payment of a stock dividend is to reduce the fair market value of an interest in a corporation of a specified shareholder. Specified shareholder, as an aside, is a defined term. It's in subsection 248.1. It basically means somebody who owns, together with all non-arm's length persons, 10% or more of the shares of any class in the capital stock of a corporation. Then what happens is that the person whose fair market value is being reduced is deemed to have received a shareholder benefit equal to the difference between the fair market value of the shares issued on the stock dividend and the amount of the dividend included in income under paragraph 82(1)(a). So basically, the amount of the value shift, if we did it by high-low stock dividend, the amount of the value shift gets included in income as a shareholder benefit. And so the shareholder benefit, I'm sorry, and I misspoke. It's not included in the person whose value was shifted. It's included in the income of the person who received the stock dividend. And so the shareholder benefit is not dividend income. It's just taxed as ordinary income, so at the 48% rate. And so this is a really, really bad outcome. If you get stuck in subsection 15.1.1, because what would have happened is now you were trying to avoid a capital gain effectively on a disposition of the shares, in this case by dad in our example. And what you've done is you've instead resulted in a full income inclusion for daughter, which is going to be taxed at effectively twice the rate that the capital gain would have been taxed at, and in any event is taxed at a higher rate than a dividend would have been. So really, really bad outcome. And if ever you see yourself attempting to pay an asymmetrical stock dividend, or you see somebody else attempting to pay an asymmetrical stock dividend, like you should be dropping everything and trying to figure out why subsection 15.1.1 does not apply to that asymmetrical stock dividend. And if the answer is that it does apply, then you should be saying something, because that is a potentially very significant problem. So that's slide 11. Did we have any other questions on topic number 8? Yeah, Leah?
Sorry, this is kind of a stupid question. What's a high-low dividend?
Okay, a high-low stock dividend is just referring to a stock dividend where you add some hilariously low amount to the stated capital of the shares, and the shares that are issued on the stock dividend have a very high fair market value. So in our example, a stock dividend of $1 million of value with $1 added to stated capital, and therefore an amount of $1 for tax purposes, that's a high-low stock dividend.
Okay, thank you.
No problem. All right, well, if there's nobody else, we can stop recording and we can take a break. It is...